But think about the Chinese. I mean, I credit them with getting us out of the 08-09 crisis. They acted as when Bernanke was slow, they acted as I would say, the asset purchaser of of last resort. They came in and bought $100 billion worth of commodity assets in Canada and Australia. They really injected the markets with liquidity. They may not be in the same position vis-a-vis debt that they were back then, but I would not underestimate their ability to hit the system with massive stimulus. They still have a closed capital account. They can do what they like. If the dollar does begin a weakening period, that is going to be a green light for them to really go all out in terms of adding liquidity. And so when I think of Europe is kind of dead. They're not very dynamic. As we know, the banking index is down still 90% from its 07 peak. It's dropped 50% in the past few months. It's sclerotic. It's an old, crusted, centralized system. But the Asians are dynamic. The Chinese are very dynamic. I wouldn't rule them out, because you're saying, the foreigners don't have. When I think of foreigners, the only group of people I'm thinking about are the Chinese. And also after this virus, there's precedent for it. I mean, they don't actually have to debate or, pass anything. Xi can wake up and say.
So what you're implying is, one of the ideas you've got in your head is that this cycle of boom and bust driven by stimulus basically this is no larger than a larger variation around the mean, and we just go back to normality again because the central bank don't let it happen.
Right. Well, I might not have thought that, except that they've been.
That doesn't balance well with the Bitcoin gold view. Or it could be it could be a balanced portfolio, which is it all works out. They massively overspend, but if it doesn't work out, you make the money on the other side.
No, I think this is the perfect best environment for gold, and certainly Bitcoin. If they inject the amount of liquidity that they will need to create a dollar bear market. Oh my goodness. What's unbelievable about this current period is that the gold is, as you know, it's broken out against your GMI basket of currencies to new highs, but the gold is at 1650, okay, with the dollar near the highs. That's unbelievable. 3-4 years ago, I never would have thought that. No one would ever thought that. When the dollar begins a bear market, that's when gold goes into hyperspace. You see, the fact. So I don't, and I think it's two ways. And if you're going to have your 1929 death scenario in default, well, then gold has a bit as well.
Yeah, but I don't see a world that gold doesn't work. Or
I hate to say it.
That's terrible. Yeah,
it doesn't work. But it does seem like this is the best of all worlds for it, and then also for Bitcoin, because Bitcoin as has been
buying them both every day at the moment.
Yeah,
adding.
Yeah, the moment like that night you sent me a message and I said it back to you. You said I can barely sit still. I'm so bullish Bitcoin. It's right, because Bitcoin was invented as a result of the breakage or inconsistencies that exist in the legacy world, in the existing financial system. And so, if you're not going to own Bitcoin a week ago or today, even there's no difference between 5,000 and 6,000 and 6,500. It's all super cheap to where it should be. And if you're not going to own it now, then I think there's no better a time. The macro fundamentals will never be as supportive as they are now versus price. So I see a scenario where the great bull market and maybe the focus. Look, I'll give you an example. The gold miners, for instance, are an extremely undervalued, cheap sector. And again, this is not my specialty, but the entire gold mining sector is only a few $100 billion. I mean, Amazon is 3 times larger, I think, 3 times larger than all the gold and silver miners around the world. So, right, maybe now I understand a lot of the Bitcoin people say, oh, gold is for old men and no one cares about it. And there'll be a generational change, where everyone will sell their gold and buy Bitcoin. The bottom line is that gold is a $10 trillion market. Bitcoin is a $100 billion market. Digital asset ecosystem total value is maybe 300 billion, 250. But anyway, my point is that for larger institutions, players, they can't buy enough Bitcoin for it to be relevant in their portfolio. And gold prices could double, triple. You could have a $25 trillion asset class in 5 to 10 years. That's real. And I think that's upon us now.
What does our macro world look like? Forget this other world of the digital side for now, but let's go to old school macro. What does it mean when there are no rates for any of us to trade? We all made our career in rates.
Yeah, I think, look, macro has been on a slow decline for the last, I would say, since 2012, 13. There have been opportunities, of course, and the best managers will always make money. That top 1% of hedge fund managers will always make money. It's the nature of things. But macro, as an asset class that has, let's call it an asset class that has wind at its back, I think, that died a few years ago. And, hence you see the retirement of some of the great, the great classic global macro guys. And there really aren't that many young guys, if any at all, coming up, because the opportunity isn't there. The great open-ended opportunity is in the digital space, crypto, Bitcoin, however, I mean, there are, if you're a 25-year-old today, you're not going into macro because you want to analyze central bank movements or flow liquidity. That's all.
But they do. I met this guy, this incredible guy who was on Real Vision, and he's like a 22-year-old, smartest guy I've ever met. He's already been working in his part-time for, a hedge fund that you've worked for in the past. Amazing. And he's doing all the central bank analysis, the swap lines. And like you, I'm kind of thinking, look, that's great.
Yeah.
But there's a whole world that's going to offer you a bigger risk-reward set. Because I think in macro, in the big macro terms, because of the time horizon of the demographics and the debt bubble and all of this, this is probably the last great patch of returns to be had from, let's say, this credit cycle, the exit of the baby boomers, and then this however the dollar plays out. Call it a spike and then a collapse, or a collapse of all value of fiat currency. That's the whole macro opportunity set.
Yeah.
It's finished.
Yeah. I mean, look, I think you can construct a portfolio, a global macro portfolio of, let's say 15 or 20 different bets that are across all the different assets. In theory, you can. I mean, if you look at, and I think I sent you this, the Crescat guys have been doing very well. And, they have a very interesting portfolio. I looked at their portfolio, it was a year or two ago. They have lots of different bets going on, nicely allocated. But now that, they have one bet, which is this bet, this one bet. So the problem with global macro hedge funds and global macro portfolio management is there really just aren't enough bets out there like there used to be. You have a handful of bets and that's it. And that's not really sort of a proper way to run a portfolio. This endowment that you say I help advise, I mean, we literally have a book. We have hundreds of positions, but it's across private equity and VC and equity and debt and 50 different funds and all sorts of things. It's a truly diversified institutional portfolio. That, to me, is sort of a more interesting way forward.
Tell me about that portfolio and I presume you've had some meetings recently. How people are thinking about the changes in the world and the structural changes. How does an endowment deal with this? Because you've got infinite time horizon in theory.
Yeah, we have a very large exposure to private equity, I think, versus the norm, north of 20%. It's because we don't need to draw on the money, and so we have that luxury, and the returns there have been very stable. We haven't been in bonds, in long dated bonds. We have short dated bonds as a cash proxy. We have some gold. we have quite a few funds. And so, we have funds who are actually doing well. We've been with certain hedge fund managers for 10, 15 years. And guys, who over the cycle, different cycles have been able to produce returns. But we're really looking for what I would call idiosyncratic alpha. However, we've moved into into healthcare, a few different healthcare funds that have a little more volatility. The big advantage an endowment has is that we really can handle a lot of volatility underneath the portfolio. We have our allocation to equity. It's not big. I mean, to straight equity.
What kind of percentage is that listed equity?
It's over 30%, but it's less than 50. But we have things that are equity-like. I mean, so 30 that way, and then another 20, let's say, in private equity, which is really, I think for us a better way to get exposure to growth, because in private equity, there are moats. We can be involved with businesses that have serious moats around them.